Hello, everybody. My name's Drew Demon, and I'm the Devil Stockbroker. So we got a lot to talk about in the broader markets today. We've had quite a bit of a bull rally that I wanted to go and dig into a little bit. Some of the research I found was a little bit interesting, pointing to a market that is on its face looking very bullish, but once you dig into the meat of it, is shaping up more like a bull trap. So let's get into it. So let's cover some of the macro stuff first before we get into what the rest of the market is doing. So right here we have the dollar currency index, or DXY. This is a general indicator of the strength of the dollar versus the other top currencies in the world. Right now, inflation is still running rampant worldwide. Most of the European powers between the UK, the Euro, um, and as well as Australia and Japan are all fighting inflation, and this is causing them to be forced to raise their interest rates. Each of them have done at least one 100 basis point hike, um, and now have recently all done 75 basis point hikes. The dollar index is showing that there's some relative weakness in the near term, with the dollar retracing about 1.35% since the 7th of September. The dollar index overall has been just absolutely ripping on a tear, and that's because inflation has been running rampant. The dollar has been increasing in strength, and that's creating more expenses for average consumers. It's making things more difficult to obtain in consumer cyclicals and consumer durables. It's making gas more expensive and other, inflation factors that we see directly in our day-to-day lives. In the world market, however, this is actually creating bigger problems for the United States because it's creating a huge rush to the dollar that has been building over the last several months as other currencies have weakened and the dollar has strengthened. This has caused the entire market to focus on throwing money at the dollar, which is further inflating the dollar and further creating problems for the Fed, which is prompting them to get more and more drastic, and take more affirmative action in order to drive down inflation and fight this effect. As of recent, you can see that we've had this little bit of retracement, which may yet last for a little while, and we may see the dollar start to retrace back to the 50-period moving average. That's this green line here on your screen. In direct response to this, assets like gold have been completely smashed as compared to their seasonal and historical performance. Right now, gold is not a attractive asset. At least it hasn't been for the last several months since our March sell-off, when the initial market sell-off hit us. Everybody rushed into gold, and then we haven't seen this high since then. Now gold is back down to a low since the previous year, back in 2021, where gold was trading at around 150, $158 per ounce. This is actually an attractive buying area, and while the dollar is this strong with showing relative weakness, we may see a buy into gold. This double bottom here on the chart is actually particularly interesting as far as technicals go, indicating that we'll see some strength. You notice that we had the same exact thing happen here when gold had sold off back in 2021. We had this double bottom happen, and then gold shot up to establish to retest a previous historical high at $180 an ounce. So if we see this happen again, this is usually a late stage market crash indicator showing that as inflation starts to peak, or as the Fed starts to really start working on hammering down the dollar and trying to fight inflation, we'll see the dollar sell off and gold start to rise. And this will translate to a big sell off in the stock market as well, because gold is considered a safer, more stable asset. And this is what institutions will go into as they try to establish a stable asset base for their entire holdings, portfolios of holdings. Looking a little bit further, we should go ahead and take a look at the 10-year bonds. This is also, I know this is boring stuff, but this is important to understand for what the entire market is going to be doing. Lately, the 10-year bond, which rules tons of things in our market, it rules interest rates, it rules mortgage the 30-year fixed rate mortgage rate for what people have to pay in interest on their houses. It affects transactions between banks. This is a huge marker for what the institutions are doing and thinking going into the next 10 years. And this is what most bond traders are paying the closest attention to, as well as macro traders who are looking for big implications for what the market is going to do. It's important to keep in mind that bond traders tend to be much smarter because their money rules the market. They have the biggest assets in the market. They are the heavyweights. So whatever the bond traders are doing is something that you as a stock trader or any other type of trader really should be paying attention to. So going back into history, there were some significant areas where bond increases, bond yield increases, which usually indicates a loss of price in the bonds as yields go up. And this is typically indicative of a stock market crash because as these yields go up, the bonds become a more attractive asset for institutions that are looking for a safer, more guaranteed return of investment. And as we were going into a weak period in the economy, going into 2018, 2019, you could see that the bond yields were starting to go up, and they were marking out a previous high at around 3.2%. And if I set a level here, you'll notice that we passed this twice. We tested it once, passed, and then had a false break, and then retracement the second time, and now we have broken it again, and we are starting to show a little bit of weakness, but this is still very early to tell yet. Right now, the RSI is still very strong, as is the MACD, indicating that bonds are still likely to continue rising going forward, and we may see them reach about 3.5%. Now, this is immediately going to translate into more difficulty for the market because as bonds become more attractive, that's going to cause institutions to pile into these bonds and take money out of the stock market. In addition, this is also going to raise the 30-year fixed rate mortgage rates for housing. So it's going to be even more difficult for people to borrow money in order to buy a home, which is going to further exacerbate the housing crash that's going on right now. If we go over to the 10 and 2-year yield curve, we see that we've had a little bit of a pullback, but not very much of it. Right now, the market is still pricing in some pretty high yields for the bonds, and the future of the economy is continuing to look very bleak. And despite this, the market has been going up. Now we finally get on to what is the broad market doing? What is the SPY doing? We had a really great week for bulls this past week. We had a bottom form here at previous support that you can see here at around 390. I did call this level out exactly. We wicked through it and then bounced the last 3 days of the previous trading week. And now we have retested our previous highs at 407. Next week, we've got several things going on. Starting on Tuesday, on September 13th, we have the core inflation numbers, which are going to be released for CPI, as well as the monthly budget statement from the federal budget. This is also going to this has a direct effect on the Fed's decision for their rate hike that's going to be coming the following week after the FOMC meeting. After Tuesday, we have the PPI, which is going to be the producer pricing inflation, and this is one of the metrics that the Fed treats as more authoritative, air quotes. They are anticipating a drop, so if we don't see that drop on Tuesday and Wednesday for the CPI and the PPI respectively, this is going to force the Fed to be even more aggressive in fighting inflation. I'm going to briefly show you the current inflation rate, which a whole bunch of different media outlets have been saying inflation has peaked. I'm not sure why there's so much rhetoric that inflation has peaked. We still haven't even really seen us get through our first real wave of inflation. If you look back at this chart, this is a weekly chart going all the way back to the 1960s, where you can see inflation in 1969 to 1970, 1973 to 1975, and then 1978 until 1982. And each of these created this has been often referred to as a bullwhip effect, where inflation spikes in these massive patterns. And you can see that it's happened before in the market as well. We've had inflation spikes that occur during relaxed monetary policy. This is the nature of inflation because inflation is extremely tricky and not very well understood, despite what the Fed would have us believe. So this first wave that we've seen here in inflation, while it may have peaked for now, in the long term is not fully dealt with right now. We're still very early on in our phase of inflation, and we're seeing that housing prices and more sticky inflation factors, real estate in particular, makes inflation so difficult to fight once it's settled in. And the housing market is beginning to retrace, but this is only just the beginning. So we still have to see more confirmation that inflation is in fact going to come down. So the rhetoric that's coming from mainstream media is at best extremely early. It's way too soon to tell that inflation has been dealt with. There's absolutely no guarantees that we've actually handled it at all. And honestly, this small retracement that we've had in the last couple of weeks is it's still in an uptrend. So even this CPI index bouncing around the way it has done nothing to confirm that inflation has peaked. It may perhaps be weakening, as you can see on the MACD, there is weakening momentum, but it doesn't guarantee that it's over. So what does this all mean for the market, and why am I talking about all this? The main thing that I'm trying to point out is that macroeconomic factors that are affecting the market right now are very disjointed from what the market has been doing in the last just week of trading. We had an extremely bullish week, and I know that I was calling out bearishness for the last 3-4 weeks, and a lot of people were, including myself, were not expecting a rally off of this bottom. I did take profit from a lot of trades going down here as soon as we crossed through the 50 daily moving average on the SPY. And that's something that I encourage everybody to do, is that when you see those profits in front of you, take them off the table. Guarantee yourself some wins and keep building capital and keep a steady supply of cash available in your portfolio as you achieve small victories. And that momentum is what will carry you forward in building wealth and your strategy to achieve financial independence. But a lot of people that stayed in may have been rug pulled here when the market ripped to the upside. And a lot of people are thinking right now, I know that they're looking at this going like, oh, wow, the RSI has cut through its moving average and the MACD is starting to cross over. And look at what the SPY's been doing. It's been moving up just perfectly vertical for the last 3 days in a row. Like, I feel like I'm on the wrong side of the market. Maybe this is the bottom. Maybe it's over. Well, I wanted to come back here and just let everybody know that this is probably not the case. This is a bear rally. This happens in the market. Even in bear market, the bear rallies when the stock prices shoot up are very sudden, very unexpected, and unfortunately, they pull in a lot of retail investors and a lot of inexperienced investors into jumping in the market when it is not advantageous for them to do so. It's a short, temporary burst of momentum to the upside in order to give the market some relief. Usually, it's created because of shorts covering. This latest article that was published by Bloomberg on September 9th, that was just this Friday, force buying puts a floor under stocks nobody else wants to own. Short sellers, options hedgers, and quants are seen driving an up week, and retail and fund outflows show growing risk aversion amid the Fed. In a week that saw discretionary buyers beat a quick retreat from risky assets, another set of traders stood up to halt a 3-week plunge in the S&P 500, those with little choice but to buy. They included short sellers whose rush to cover lifted stocks they're betting against to gains of more than twice the markets. Options dealers were another bullish force after getting caught needing boost hedges by buying stocks when they rise. Certain quantitative traders, for whom chart thresholds are a call to action, also made their presence known. Combined, these players helped the markets overcome a fresh wave of selling from day traders and fund investors, up 3.7% over the holiday shortened week. The S&P 500's advance flew in the face of Federal Reserve Chair Powell's persistent hawkish message. While it's debatable how much bad news is priced into 2022's bear market, the prevailing skepticism towards stocks makes Andrew Slyman optimistic. Quote, "There's a huge negative bias for the market right now, and that is extremely contrarian signal," said Slyman. Global equity manager at Morgan Stanley Investment Management, markets are set up for a very good fourth quarter. There's a lot of funds betting the markets are going to drop. So what this article is getting at is that currently the market hit a temporary bottom because short sellers were suddenly trying to all take profits simultaneously. And that's why I tend to take profit once I've been on a winning trend for a significant period of time. And that 50 period moving average was pretty good for me. Once we saw the market starting to wick down like this was our clue that perhaps we were going to see a little bit of short covering and then we would see a bit of a rally, a bit of relief in the market. And we did. What was interesting is that we saw so much of it so quickly. And I think that this may be exacerbated because of a lot of other factors. We saw recently that Citadel Europe actually received a liquidation notice. And I want to give huge props to the user Got a Funny Shaped Head for pointing this out. Gov.uk publishes liquidation notices for particularly large institutional funds, and one of them, perhaps one of the biggest, Citadel Europe LLP, received a company liquidation status from Gov.uk. This notice is, while not absolute confirmation that Citadel is going bankrupt entirely, this does indicate some pretty bad signals for the market overall. Funds like Citadel are notorious for using shorting as a main part of their strategy. They look to target stocks which are performing poorly or considered overvalued by market fundamental standards, and this is a good bit of the reason why we might see some short covering. If there is a major fund such as Citadel Europe being liquidated, they've been net short on many stocks, including some of the underperformers in the SPY, then we may certainly see some of those companies start ripping as those funds are forced to liquidate, i.e., cover their short positions. And we've seen something recently happen in the meme stock market where AMC started ripping unexpectedly as well, and so did GameStop. GameStop, since its earnings, which honestly weren't all that great except for the news that they were partnering with FTX, GameStop ripped from $24 all the way up to $28.92, which is pretty significant. They're actually now starting to test the average trend line that I set here from its peak to its current price right now. As well, they're bouncing off of the bottom of a regression channel, which I didn't expect such a sharp V-shaped recovery that we may possibly see upside up to $35, $36. In any case, this video isn't really about GameStop so much as it is the broader market, but I'm noticing some reactions from the rest of the market that indicate that something else is going on. Now, if I go ahead and draw in some of these technicals on the SPY, we can see that actually what the market has begun to form on the hourly candle chart is an ascending wedge. This is a particularly bearish signal showing that the market is weakly ascending to the upside with a great deal of resistance to it up above. We're actually getting very close to approaching the 200 period 1 hour moving average, which is going to serve as some pretty significant stiff resistance for the market overall. Additionally, we've got a lot of headwinds in front of us here from 409 onward. This price is an area where there was significant consolidation going back to late July to early August, where the price kind of just hung out for a long time, all the way until mid-August when it finally broke through and we eventually hit the top of the market on the 16th of August. Now, since we hit that peak, we sold off pretty quickly, and we cut through that area really, really fast. it's kind of natural that we would need to retest it one more time before we start to see the next leg of selling. So I wanted to give this fair warning to everybody who's looking at this market, who has probably been short for the duration of this entire downtrend. Maybe you didn't take profits, maybe you did, but you're looking at this market, you're seeing this rally, and you're thinking to yourself, man, I wish I had switched long, or man, I'm on the wrong side of the market. I need to get back in, or I need to get out of my short positions. Just hold your horses and look at the technicals and look at the market and the macros that are surrounding you. Even though we see this big rally, they come quickly, but they can pass just as quickly. We have a lot of headwinds in front of us. And for me, I've taken most of my profits and I've stepped aside. I'm not playing this bull rally. I'm actually sitting on the sidelines. I had like one call in the SPY as like a maybe that turned out to be pretty profitable. But other than that, I've basically stayed out of the market's way. I was able to catch this run from here all the way up to around 405, and then that was my take profit super short scalp done. The market right now, what it's currently doing is saying to me that there's nothing but headwinds and weakness in the market. Despite the really rapid ascension in the short term, the last leg of the market's movement since the on the last day of September, uh, the last several hours, I should say, of September 9th, showed extreme weakness where it couldn't break above this ascending wedge channel. And if we look even further out, if you subscribe at all to harmonic patterns, we've basically been trading in a giant harmonic cipher pattern, which has been bearish ever since we hit the top. And its target, which we have yet to hit, is anywhere from 380 and 50 cents all the way down to $320 all the way down here, which you will notice is deep within my panic zone, where I anticipate the big capitulation crash to occur once we spend enough time in that panic zone. In the temporary, we have a lot of bullish signals coming in from the market showing that on the daily chart, we've got crossovers, we've got the RSI going strong, we've got the MACD getting ready to cross up, STC indicator going green, and that can fool a lot of traders. But looking at the macros, looking at what inflation is doing, looking at the situation with the dollar index and the other funds that are going around, as well as the other macroeconomic factors with oil and gasoline, there's too many factors in front of us that point to bad news coming forward, that I would rather stay out of the way of this market rally and just wait for my next opportunity to enter into a heavier short position going forward. For me, I'm going to be closely watching the hourly charts on the S&P markets. Primarily, I'm looking to go short on tech sector and anything that is heavily reliant on semiconductors, consumer durables, and any major expensive or luxury items that people tend to buy during um, during economic affluent periods. Right now, we're going into major contraction, and I'm anticipating third quarter earnings for most S&P companies to be extremely bad. So, the market, I anticipate to price this in once it gets through this little rally, and I anticipate a rapid dissension going into the Fed rate hike decision, which I could estimate being as high as a full point hike. If we see 75 basis points, then the market will have met its expectations and it'll probably continue moving in its trend, chopping its way through the rest of September, probably heading a little bit down. But if the Fed surprises because nobody in the market has been listening to them, then I anticipate the Fed will make a very strong stance going into the Fed rate hike decision meeting. And when they finally do speak and make their announcement, we should not be surprised if we hear they have raised the rate by as much as 100 basis points. Going early on into next week, I anticipate that the market will probably chop its way maybe to the top of this ascending wedge. It could reach as high as the 200 moving average before I see a drop down in the market. Once we reach these heights, I will be loading into puts big time. This is basically my strategy, is to stay out of this little rally here completely and wait for weakness near the top. Once I see evidence that we've reached a top, paying close attention to what the MACD is doing and looking for a top in the hourly MACD, as well as bearish divergence on the RSI. If we start to see lower highs on the RSI with higher highs in the price, then I know that downward momentum and bears are going to come in strength back into the market. Because despite what we've seen here, we know that the market is only down 8% since this move in the last 3 weeks. We've got a lot further to go in order to see another 15 to 20% sell-off in the market, as we would normally anticipate with seasonality in a bear market such as this. Big signal that I'm paying very close attention to is the VIX, which on the daily, if you'll notice, we've had this kind of move before. Ones where we see the VIX coming down from a very long leg of buying in the market. The VIX comes down as the SPY goes up and fear leaves the market. As a direct result, we see eventually we find a bottom here, a double bottom specifically, such as what we saw going into April of this year. And as soon as we did, we had a big drop in the SPY, the VIX shot up, and then it got a little bit of strength, and the VIX came back down. Then we suddenly shot all the way up to 3650 on the VIX, as the SPY made a massive drop over the course of several weeks. The biggest being a rapid 3-day in a row drop in April. We are now seeing the same move as of recent, which, if you'll notice, this is part of a much larger harmonic pattern, which is showing that we have broken through the first target, and as we anticipate a little bit of bullishness coming into the market, the VIX will relax and form a double bottom here right around 22. This is precisely what I was waiting for, was for the VIX to retrace back down to around $20 and then for the VIX to suddenly shoot back up. And this is the same move that the VIX has done over and over again. It did it here, it did it here, it did it here. And every single time that we've had these big wave sell-offs in the market, it was preceded by a big, deep breath taken, as we see that the market is about ready to take the plunge off the cliff. Right before you go and take a dive, you take one deep breath, and then you make the plunge. It's the same behavior as with the SPY. You notice the SPY starts to sell, takes a deep breath, and then takes the plunge. Deep breath, plunge. Starts to sell off, deep breath, and plunge. Every single time the market's done this, we've seen this same consistent behavior in the VIX, just inverse. So because the VIX is a little bit more reactive, it makes the moves a little bit more predictable. So hence, we see the VIX started to rip as the market sold off, taking a deep breath, and next we make the plunge. So that's what I'll be looking for going into the next several weeks in the market. I think that by the time the CPI print has come out, that the market will start to sell off immediately. But at least before the Fed rate hike decision is made, I certainly think that the market will have made its decision. And the macros just very simply don't look good to me. So I'm going to stay out of the way of this bull rally, and I'm going to look for my next entry on the SPY. One final indicator that I will give to you, this is one that I want to give credit where credit is due to Money Time Machine, which is another YouTube channel that I was notified of, and I have to say that this has been an extremely reliable indicator. The HYG, or the high yield grade bonds, these are extremely risky corporate bonds, or a basket of risky corporate bonds, and whatever this bond indicator does, whatever this ETF does, is an indicator of what the SPY is going to do in the future. In the last couple of days, we've had three things. We've had 3 green days in the SPY. So if we go ahead and put the SPY over here, you see that we've had these big green candles 3 days in a row. It was 3 really good days for the SPY. Nice big green thick body candle indicates strength, right? And that's what everybody is thinking. Well, if you look at what the bond traders are thinking, they had 2 green days, and now we've had this indecision doji candle that has really kind of capped off what the market is going to be doing for the next week. So this candle, this one indecision candle, tells us everything that we need to know. That the resistance here is too strong for the market, and the bond traders have decided that things don't look good going forward, and likely they're pricing in a much higher Fed rate decision than what mainstream media has been telling everybody else. On to just a couple of stocks in specific that I'll be looking to enter into a bigger short position on. Apple is one of the biggest, absolutely. Apple is currently running into some headwinds right around 170, 157, $158. This is a significant area of resistance that previously had been support. You see that we had bounced on it 1, 2, cut through once, retraced, and then cut through it one last time before we entered into this consolidation range. It seems to me that we are going to have to bounce off of it at least a couple of times. But recently we printed this gravestone candle on Apple that indicates to me that we may have some early bearishness. So we'll see what it looks like going into the CPI print. But I'm anticipating that Apple is going to continue to chop for a little while before eventually we see a big sell-off. Right now, I'm just kind of standing off to the side because I anticipate that Apple will continue to do this sort of indecision pattern for the next week as the MACD struggles to make a decision and the bullish divergence on the RSI, as far as technicals go, indicate continued strength. However, as Apple goes into this chop phase, I anticipate that the RSI is just going to hang around in its midline range before it finally makes a decision and we see a huge drop to the downside on small movement in the price. That'll be enough of an indication for me to enter into a short position for Apple going out till October. Tesla, which has shocked absolutely everybody by ripping back up to $300 almost on its hourly chart. You can see that it had formed a very clear double bottom, which would have served as a sign. And I apologize that I wasn't able to pay close enough attention to call this out on the 6th of September. But as we've seen Tesla start to rip to the upside, and we're looking into some headwinds here at around $300. This is probably about the area that if you were long on Tesla, I would absolutely think about taking profits, since overall Tesla is still pretty much in bear market territory, and they still have the uncertainty of their Twitter case going forward into the next couple of weeks. So even though Tesla may have found a little bit of strength in the market recently, you'll notice that it is only just barely breaking through its 200 daily moving average, which has been fairly middle of the road over the last several months. So now, as Tesla has broken through its 200, creating a lower high, I anticipate the next candle starting tomorrow, Monday, and Tuesday to print lower, and that will confirm a rejection off of this 200 moving average, where we will see that Tesla has formed a lower high since this previous candle here, and then we'll see more selling to come. Perhaps a little bit of consolidation around 266. This has been a rather significant area of support for Tesla, considering the two wicking candles that we saw during that double bottom. But if we retest this and we don't see that same support that we saw last week, then I believe that we'll see Tesla selling off back down to around the $240 range before earnings going into late October. And one more index just for everybody else. This is XLRE, the real estate sector index, which you'll notice that I have kind of created this little cross pattern. As we've seen, we were setting up a trend here where we broke that trend and established a slightly higher low here. However, we are struggling to meet this resistance here at $43. And you'll notice that our 100 daily moving average is sitting right here along with the 20 moving average and the 50 directly below it. There is a lot of headwinds for the real estate market, and I don't think that it's going to last. This is perhaps my most bearish play, where I anticipate the market selling off very quickly going into October as the housing market shows continued increases in listings and decreases in listing and asking prices. The MACD is showing a bullish crossover is pending, but I believe that this will be a false crossover and that we'll see continued selling to the downside throughout late September. This is a seasonal rally that happens during midterm Democratic presidential terms. This is this is just based on history of the past of what the stock market has done. This is a seasonality chart which shows consistent historical accuracy with market rallies and dips pending an election. And since we're going into midterm year elections with a Democratic president, this is actually one of the most bearish seasonal occurrences in the market. And you'll notice that here in early September, we tend to get a little bit of a rally going into mid-September, and then once we hit that peak, then we rapidly sell off. Now, the market overall has been showing that it is in a straight up bear market, and by all accounts, we are bear flagging big time. So, as we reach the peak here before this coming Friday, I anticipate that this next sell off could be possibly one of the worst that we've seen so far this year, with potential for the SPY to retrace as far down as the 340 level by the end of October. And this is backed up by the seasonality chart, which shows repeated sell offs going into September and October. And keep in mind that this is just an overall seasonality chart as opposed to seasonality within a bear market. So, with us being in a bear market now, conditions have changed. The macroeconomics are even worse than what we see during your average trading season. And it's just a fact of history that September and October are some of the worst months performance for the entire stock market. So I do want everybody to be very careful going forward. Please make sure that you are hedging all of your bets and keeping yourself insulated well with cash and protecting your investments. Look for opportunities to go with the market trend. It still remains a fact that you stick with the trend because the trend is your friend, and you certainly don't fight the Fed, and the Fed wants to see the market go down. So keep all of this in mind going forward into next week's trading session, and I look forward to seeing you at the bell. Until then, have a hell of a weekend.